debt. Welcome everyone. Today we begin our deep dive into the corporate debt market. Companies raise debt for two primary reasons: to fund short-term operations like working capital and to finance long-term capital investments such as building a new factory. There are two main avenues for this. First are bank loans, which can be bilateral, involving a single lender, or syndicated, involving a group of lenders. Second is the capital market, where companies issue securities like commercial paper, notes, and bonds. It is interesting to note a major geographic difference in how companies fund themselves. European firms rely much more heavily on bank lending, whereas in the US, companies lean significantly more toward the financial markets to raise their debt. As you can see on the slide, corporate debt is raised for both short-term operations and long-term investments. The choice is between bank loans, whether bilateral or syndicated, and the capital markets through commercial paper, notes, and bonds. As a trainer, I want you to remember that the choice often depends on the company's size and credit strength. Larger, well-known corporations have easier access to the public capital markets, while smaller firms often rely on the more personal, structured relationships they have with their commercial banks. Bank loans and syndicated loans. Let's look closer at the banking side. A bilateral loan is the simplest form, involving just one lender and one borrower. However, for very large amounts, we see syndicated loans. Here, a group of lenders, or a syndicate, joins together to provide funds to a single borrower, spreading the risk among several banks. While bank loans are traditionally private agreements, they can also be securitized into instruments like collateralized loan obligations or CLOs, allowing them to be traded by other investors. The primary advantage of bank loans over bonds is their flexibility. Banks can highly customize the maturity and repayment structures to fit the specific seasonal or project-based needs of the company. The diagram clarifies these structures. A bilateral loan is a direct link, whereas a syndicated loan involves a group of lenders. These can remain private or become securitized for the broader market. As a professional, you should view bank loans as the cool-schmood suit of the debt world. Unlike a public bond, which has a rigid structure for thousands of investors, a bank loan is a negotiated contract. If a company hits a temporary rough patch, it is often much easier to negotiate a waiver or a change in terms with a small group of banks than it is with a vast sea of public bondholders. Commercial paper. For short-term needs, corporations use commercial paper. This is an unsecured, short-term promissory note. It is the primary tool for funding day-to-day working capital or providing interim bridge financing before a company secures a long-term bond. Maturities are very short, typically ranging from overnight to 1 year. However, because these are short-term, companies face rollover risk. This is the danger, that a company cannot issue new paper to pay off its maturing paper, perhaps because of a sudden market panic or a drop in the company's own credit rating. For this reason, many companies keep backup credit lines with banks to ensure they can always meet these obligations. This slide defines commercial paper as a short-term unsecured note. Its purpose is for working capital and bridge financing. But we must always be mindful of rollover risk. As a trainer, I emphasize that the commercial paper market is a fair-weather spend-she market. When the economy is strong, it is a very cheap way to borrow. But during a financial crisis, this market can freeze up in hours. This is why credit analysts look so closely at a company's liquidity. They want to know exactly how a firm will pay back its paper if the market suddenly refuses to roll it over. Corporate notes and bonds. When companies need money for longer periods, they turn to notes and bonds. We generally classify these by maturity. Short term is under 5 years, intermediate is 5 to 12 years, and long term is over 12 years. A unique instrument in this space is the medium-term note or MTN. Despite the name, medium-term is actually a misnomer. MTNs can be issued with very long maturities. The key feature of an MTN is flexibility. Unlike a standard bond which is sold all at once, MTNs are offered continuously by the company's agents. This allows the firm to fill the gap between their short-term commercial paper and their large long-term bond issues by raising exactly the amount they need, exactly when they need it. The classification on your screen shows the maturity brackets and highlights the medium-term notes, MTNs. These offer flexibility because they are offered continuously and can be customized to match specific investor needs. As an analyst, you should think of MTNs as a company tapping the market whenever the interest rates look attractive. Instead of one giant $500 million bond deal, a company might issue 10 different $50 million MTNs over several months. This shelf registration approach reduces issuance costs and allows the treasurer to be much more tactical in how they manage the company's long-term debt profile. Coupon payment structures. Corporate bonds offer a variety of ways to pay interest. A deferred coupon bond pays no interest for an initial period, then a higher rate later. Step-up coupons have rates that increase at specific dates, protecting investors if the company's credit risk rises. More aggressive is the payment in kind, or PIK bond, where the company can pay interest by issuing more bonds or shares instead of cash. This is common in highly leveraged deals where cash flow is tight. Finally, we have zero coupon bonds, which pay no periodic interest at all. They are issued at a deep discount and pay the full face value at maturity, with that price difference representing the investor's return. This list covers the primary coupon payment structures. We see the deferred and step-up types, the payment in kind for high-leverage situations, and the zero coupon discount model. As a trainer, I want you to see that these structures are all about managing cash flow. A young growing company might use a deferred coupon to keep cash in the business today, while a very safe established firm might issue a simple fixed-rate bond. As an investor, you must choose the structure that matches your need for immediate income versus long-term capital growth. Principal repayment structures. Equally important is how the company pays you back your principal. The most common is term maturity, where the entire lump sum is paid exactly on the maturity date. Serial maturity is different. Here, a set number of bonds from the issue mature and are paid off every year. Some bonds include a sinking fund provision, where the company is required to retire a portion of the debt annually. From a risk perspective, term maturity is the most dangerous for the company and the investor, because the balloon payment at the end is so large. If the company doesn't have the cash on that one specific day, it could face a default, whereas serial or sinking fund bonds spread that risk over many years. The comparison shows term maturity as a single lump sum, while serial maturity and sinking funds retire debt gradually. Note that term maturity carries more credit risk due to that large final payment. For a professional analyst, a sinking fund is a very investor-friendly feature. It forces the company to be disciplined and pay down its debt gradually, much like a homeowner pays down a mortgage. This reduces the refinancing risk at the end of the bond's life, making the instrument much safer for the long-term holder. Asset collateral and seniority. If a company fails, who gets paid first? This is determined by seniority and collateral. Secured debt is backed by specific pledged assets, like a building in a mortgage bond or airplanes in an equipment trust. Unsecured debt, often called debentures, is backed only by the company's general assets. In a liquidation, there is a strict seniority ranking. The first lien secured holders are at the front of the line. They are followed by senior unsecured holders, and at the very back are the subordinated or junior debt holders. Understanding where you sit in this pecking order is vital, because in a bankruptcy, the junior holders often receive nothing at all. This diagram illustrates the seniority ranking and the role of collateral. Secured debt has the highest protection, followed by unsecured debentures. The order is clear. First lien senior unsecured subordinated debt. As a trainer, I always remind my students, yield follows risk. Subordinated debt pays a much higher interest rate because it is the most likely to be wiped out in a crisis. When you are looking at a company's balance sheet, you must trace the assets. If all the good assets are already pledged to the first lien banks, there is very little left for the unsecured bondholders if things go wrong. Summary of corporate debt. To wrap up our session, we have seen that the corporate debt market is a complex and highly structured environment. Companies use a mix of bank loans and capital market securities to fund everything from daily expenses to decades-long projects. Commercial paper handles the short-term liquidity, while bonds and notes provide the long-term capital. We've seen that these instruments can be customized with different coupon and repayment structures to suit the needs of both the borrower and the lender. Finally, we learned that seniority and collateral are the ultimate safeguards that determine an investor's protection in the event of a default. Our final summary brings these pillars together. Corporations use loans and securities for funding. Commercial paper is for short-term needs, while bonds vary by maturity, coupon, and repayment. Ultimately, seniority and collateral determine the level of protection. As a trainer, I hope you leave this session with a clear understanding that corporate debt is a contractual world. Unlike stocks, where you hope for growth, bonds are about the legal promise to pay. By understanding the features we've discussed today, you can accurately price that promise and protect your capital in the global markets. Thank you.